kick this session off. So wherever you are right now in the world, good morning, good afternoon, good evening. It is time to continue yesterday's conversation. It is time to look at the market afresh. It is time to do what we do, and that is put the work in. Nasdaq here is flirting with its ninth day of gains, currently in the red, off 0.25%. And it has been a tremendous rally off of what was attributed to the unwinding of the Japanese yen carry trade. Whether or not and how much of that has been unwound, that remains to be seen. There was a really interesting read this morning that I was reading this morning, and it's titled, I'm going to throw it in I'm not going to cover it, so I'm going to throw it inside the comments over here. And it's called The Carry Trade Trap. The real reason why the Fed has waited so long to cut rates. And so I only perused it, I only read it, focusing a lot on this last section over here, if you're interested. But basically, what it is saying that as the Fed begins to move towards easing, towards those rate cuts, which is easing, just as tapering the QE, the quantitative easing was tightening. At that point in time, things are going to accelerate. It's going to cause potential, well, I don't mean to be sensational, potential carnage across the stock markets. And as the Fed has to come in and address that, the inflation is going to skyrocket again. Anyway, it was a good, interesting read. I look forward to spending more time with that myself. But let's go ahead and take a look at what's going on across markets. Dollar looks like it is dollar clearly continues to be under pressure. You're looking at a 3-day chart over there. Let me move to the daily, and it looks like that we are breaking down that structural resistance that has not broken since last summer, and it looks like a clear and clean break. Tomorrow is an enormous day. Tomorrow we have the Fed meeting minutes, and we also have the revisions to the labor market, which is going to show that there were no jobs at all gained, or is expected to show that there were no jobs gained at all in 2024. At that particular point in time, it seems that it's going to give the okay, clear signal to the Federal Reserve that they have to go ahead and they have to keep their other mandate. They have to keep the job market as tight as possible. And that might give them the excuse to go ahead and begin the easing as soon as September. Powell speaks this week at Jackson Hole, and I assume that if that is not what their intentions are, that we will see that. But ever since we saw at the FOMC meeting, ever since the press conference where Jerome Powell said, listen, why we are like the direction that inflation is headed, and we believe we're going to meet our goal, we need to see more progress. The only thing that will cause us to cut sooner if we began to see a deterioration in the job market. Sure enough, 3 days later, non-farm payrolls was a big miss. Since then, we've seen not only broadening cracks, but now the revisions might paint a completely different story. We'll get into that in a moment, but the dollar here continues to be under pressure. In yesterday's session, we were asking Luke his thoughts as far as the DXY and its current price action compared to 2019. As the Fed began their cutting cycle, the dollar was weak until the Fed began cutting. And as the cuts began, then you saw the dollar catch a bid. A couple of thoughts on this that may make the current US dollar DXY price action varied compared to 2019. Number one, China's economy is leading into the first cuts and has already been a steep decline, and they may be emerging sooner than later. In 2019, expectations was global economic growth. Worries were leading to dollar to safety and trade versus other economies. China-US trade war Reparations of U.S. multinational firms due to 2017 tax law bring lots of foreign dollars back to the U.S. Carry trade is still in play. Japan at or near zero. This may be different this round as the Japan seems intent on raising going forward. Fall of 2019, Fed cuts were seen as mid cycle cuts, not part of a larger rate cycle process, with further cuts following, different this time likely. So, above all, my expectations from a novice viewpoint is that the DXY breaking down key structure should send Bitcoin like past major breakdowns. And I don't expect the ghost of 2019 to be too relevant. Is this ChatGPT with the boldness? I don't know where is this coming from, but I'll take a look at it in preparation for tomorrow's signal. Right now, it seems that there are two varying different, pretty extreme viewpoints. One is that we have not even begun to get into bubble territory, and 2024 price action is shaping up a lot to be like 1999. The other is that we are about to crash and burn, and I don't see too many varying viewpoints as far as it's going to be some type of grind. We're going to end into some type of range or anything like that. Two varying viewpoints. Let's be prepared for both of them, but let's also take it as it comes. I guess we'll take a look at that a little bit further. Game of trade yesterday, Peter. Thanks for responding on the live stream. The ticker I use for the Russell 2000 for the historical data is the RUT on TradingView, going back to 1987. The episode I was referring to is November 1999. It is a moment where valuation differentials between small and large cap were at similar levels to today. He has a post here, by the way, of Russell versus S&P 500. This is looking at a weekly zoomed out time frame. And I want you to notice over here, as we are into, or he believes that we are somewhere in late 1999, November, that valuations, or well, here you're looking at price, but reflective of valuations heavily skewed towards the larger caps S&P 500. You could see this nice trend line break and then a sharp move up. Let's go ahead and continue looking at it. The S&P was surging at all-time highs like it is today. Why small caps were basing about 10% points below all-time highs like they are now. I don't believe there's any precedent for that except November 1999. This was also very late in the business cycle and during a tech frenzy. So you could replace tech frenzy with AI buzz. Small caps melted up between November and March 2000, along with tech, into a big market peak from it. So if the first cuts are received favorable, if the first cuts are embraced by the market, I could envision a situation like that happening once again. From a TA standpoint, they don't look exactly alike, but a lot of other factors do align. That's how I'm justifying my bullish view on small caps. Hard not to be bullish with the double bottom. The chart is very, very, very bullish, while also expecting a recession to materialize. Although things aren't going to play out the same way, it gives an idea what's possible. Let's look once again. This is the zoomed out view. And then now if you look at just the Russell 2000, you could see this nice clean trend line break. Oh my goodness, this is beautiful. Peter, so most people would put some type of trend line that might look like first this connecting these 2 points. And yes, that's a nice breakout, retest, resumption. It's a good line. Other people might then do something like that. But look, he has the perfect structure here. That's beautiful. Underbelly over here, resistance, resistance. You could then clone it, put that off the top line like this. And then you will see that the retests come right into that structural resistance. That's beautiful. I love it because that's correct. That's as accurate as you could get. But you do see that what you saw was, and this is, you saw the Russell into the end of November 1999. And then all of a sudden, as equities also in tech melted up into that peak, Russell really, really flew. And then we all went into first correction. And then I think this is being marked as when the recession took place. Here's the view of what's taking place right now, also zoomed out and looking at the weekly. And you could see that we've had, again, a trend line break and a retest. Much like over here, this was much different. So there's no retest over here, or where the retest is occurring very quickly here on the weekly. Breakout retest right there. So pretty close, pretty similar. So struggling over here, Russell versus the S&P 500 still. Nevertheless, very clear trend line break and currently very much in play. Here is the Russell just with a clean trend line horizontal after the fake out to the this usually leads to and can lead to big moves. But yeah, our expectations were yesterday, taking a look at the Russell, that if and into those cuts, that there's a chance that we take out this 2021 high. And then also, I mean, similarly, and then leading into the crash. So does that mean that we more are embracing the everything's about to crash and burn? I don't think so. I don't think so. But I also don't think that this is in play. That leaves me somewhere in between, huh? I think I'll have to continue taking as it comes and taking a look at it. By the way, just a pretty cool thread that Peter also released yesterday, and it's titled like "Recessions Bring Down the Stock Market, Not the Fed Cutting Rates." He points to, and if you're interested in looking through this thread, go ahead and find it on Game of Trades. But it points to over here, the Fed cuts rates in response to economic deterioration. It's the economic downturns that bring down the market, not the rate cut themselves. So that I mean, this is the one that I loved, because I love that, because that's the truth of it. The Fed begins cutting in response to economic deterioration, and then you see the stock market reacting. Is this kind of like what comes first, the chicken or the egg? I think so, but it's a very cool thread if you're interested in seeing it. But speaking of response to economic deterioration, that is the $1 million question about whether or not they're cutting into normalization and or a slowdown. TXMC showing that unemployment has risen faster in only 3 prior errors relative to rate hikes. Thus, starting from historically low level, the change in unemployment more closely resembles an early recessionary dynamic than the beginning of the soft landings of 1995 and 1966. Job market is more reflective that we are headed towards a slowdown, in my opinion, than towards normalization. The only thing that could change that, and this is again from TXMNC, and he said it about 6-7 months ago, the very beginning of the year. If we are indeed seeing a soft landing, what we will see will be a sharp turn in the jobs market, and we will begin to see not like a continued deterioration, but a strengthening of the job market, if indeed we are looking at some type of return to normalization. This is Lowe's. Lowe's is like Home Depot for those that don't live in the States. Their full year outlook on challenging macroeconomic backdrop hitting homeowners based on lower than expected do-it-yourself sales and a pressured macroeconomic environment. So that is indicative of the consumer beginning to feel some pressure. By the way, as gold tags 2,500, upon the breakout, we said that gold is not going to stop at 2,500. See you near 5,000. This is on my own personal belief of where we are in cycle, that the countdown to that slowdown continues. And not only that, usually gold peaks into the response after the response of the central banks, when they have to go ahead and once again come to the rescue in order to keep the music playing, because after that point there becomes a lot more interesting alternatives than gold. But right now is gold's time, I do believe, to shine. There was something else, perhaps. What do I have over here? That's not it, but I'm going to pull this up really quick. This is off of yesterday's session. Great discussion today. Diversifying into stocks definitely helps me sleep better. And at the end of the day, nobody really knows. This is CTM strong, which asset will outperform or when. We just have to rely on our back testing and statistics. I always remind myself that our systems are more likely to make better decisions constantly than I could on my own. That might be actually an appropriate lead in. I was going to go into stocks, but I'm going to go into Bitcoin and crypto and just highlighting over here the truth of it, that our systems are more likely to make better decisions consistently. Not always. There will be times that you out discretionary the systems, that's for sure. Bitcoin, but a lot of people yesterday, I think, from a discretionary standpoint, were seeing Bitcoin up in the green, a couple of percent, getting very bullish because everyone is always rooting for Bitcoin. I'm rooting for Bitcoin. Everyone's rooting for Bitcoin, and that might, in a way, play some type of bias in all of our analysis. I'm going to get into the mechanical in a second, but let me go ahead and start by we are now looking at 60% of the largest hedge funds have disclosed Bitcoin ETF holdings. There is more of at first gradually and then suddenly, and that ball of adoption keeps on rolling. This is Bitcoin realized HODL waves coming from Philip Swift, and he says that there's still a long way to go this cycle. Pay attention to when the greater than 6 months cap HODL waves drift up towards 80%. That will indicate much of Bitcoin's wealth is held in newly acquired coins. And you can see that we're not even close to it. But then again, my own personal belief as that this current cycle doesn't even get started. Yes, I was there. We not only called the Bitcoin bull market breakout at 17,250, repositioning 17,250. Not only called the low of it, we weren't calling it the whole way down, right? We called de-risking on the way down, first at 51,000, then at 35,000, and then at 27,000. But this was the only bull market breakout that we called. Second repair taking place above the trend line, and then third was getting on that resumption above the 3-hour Celsius resistance after the Luna low was put in. Except, even though calling the bull market breakout and it's never been invalidated yet, it keeps on chugging along and keeps on going. I don't really, and yes, we've hit new all-time highs, but I don't think that the bull of all bull is really running yet. And this is a good indication of when it's getting hot. But I do believe that we are more along the lines in this area. 2019, right before the Fed began cutting rates. And you could see that, or you could envision how that might play out or look something similar as we are in a very similar situation, roughly between 55, 58%. So as far as people that think this is the cycle top, I think in order for that to happen, the business cycle would be have to be allowed to play out. It would have to be a long and grueling recession that it was just extremely hard to see any growth coming out of. And that would have to happen without anything within the financial system, not just in the US. It doesn't have to be the SOFR rate. It would anything coming to a halt that would require central banks to respond. There are people who think that because of the current inflationary reactions that we've seen ever since the flooding of the system by Jay Powell in March 2020, and the U.S.'s government's direct stimulus handouts to people's bank accounts, as well as all the PPI loans that were really just like jet fuel inflationary. I see Elon talking a lot about inflation and the government's role in that. He's not talking anything about he's putting the onus on central banks and on the Federal Reserve. He's not talking about what the government's response was. Would like to see a little bit more of that. And then you see over here that we're looking at from Bitcoin Magazine, 75% of Bitcoin has not moved in the past 6 months. And that might sound really bullish to you or to me or to anyone else. I mean, this is what attracted Stanley Druckenmiller to Bitcoin when he was looking at a bear market and seeing that 80% of I don't know, excuse me, I don't know if that was 80%. I think it was closer to 60, 65% at the time. Seeing a high percentage, even during a bear market, of Bitcoin not moving attracted him at first to the asset. But I just want you to pay attention or look at it's usually look at over here when you start seeing like longer term hodlers distributing their Bitcoin. That's when price is moving up. Here you could see the distribution, price moving up. Here you could see the distribution and price moving up. And in this case, we're just moving flat, right? So what does that remind you of? Or where was the last time that we moved flat? Was it, I'm just looking. I don't know personally. So I'm looking at first 2019 in that area. We came off a little bit and then we went flat. Interestingly, so there's this actually just a correlation between price and what it's doing and then what long-term hodlers do. And every time it's rising, they're distributing into it. So I don't know how much for me, how much that this stat really is indicative of what comes next. You could see over here, for example, as finally by the end of 2019, by December 2019, as Bitcoin found its footing and then rose up into February, as it was rising up, you start seeing that distribution taking place. Yeah, I'm glad that you are here. It is good that you are here. There we go. So Bitcoin right now continues just in its consolidation inside this pattern that we're watching. Yes, I could say that, well, it looks very bullish for me in the perspective that we're about like what is it? Some ridiculous off the low, right? So price currently 275% off the low. It's been pretty much straight up, huge move, 300% move. And to see price consolidating right here, very orderly. I mean, that if it breaks out, yes, I'm going to be very, very bullish. If you start seeing any type of breakdown, likely you're going to see a lot of people, a lot of larger wallets coming in and using that as an accumulation zone for longer term accumulation. It's not until you start seeing any type of frenzied, let's say euphoric upside price action that you start seeing a lot of new short-term holders. That again, he just articulated it very well. This is when you need to watch out. When you start seeing that you see people holding less than 6 months drift up towards 80%, that's when you have to worry about that we might be towards a cycle top. I don't think we're anywhere near it. I think that, again, we're not even like the bull of all bulls doesn't begin running until monetary policy aligns. We are just still at the point of the cycle where we are still tightening, moving towards the very beginning of the easing cycle. We will see the markets may at first welcome the move to easing, but sooner than later, it appears to me that the macro is going to catch up. And it looks to me that we are headed into a slowdown from many different angles. Tomorrow's jobs revisions are likely going to go ahead and bring the narrative a lot further in that direction. Bonds continue to be bid over here, and oil is under a little bit of pressure. So we're seeing the two kind of move in unison, which is not normal. DXY selling off, so it's not as if you're seeing a bid into safety, even though bonds are bid. It's hard to get a good read of that. Euphoric. I think that if there's any type of euphoric downside price action, then I think it's more along the lines of this, and you're going to see panic cuts. Like if you are seeing something like this take place, if you're seeing something like this one take place, and markets in the red and under turmoil, and CNBC like panicking, and at that point in time, then likely we're going to see panic cuts, and those are going to be quick, accelerated, and sharp, and that's to set up a monetary policy response. So into like, hold on, the roller coaster meme when like Bitcoin is like crashing down, that's what it would be like. And I don't know, we looked at it recently of what potential downside could be in something like that occurring. By the way, if you're here today and you enjoy being here, if you value being here, go ahead and smash that like button. I would really appreciate it. It gets me going. This is major, major, major turmoil in the market, and Bitcoin coming off 62% from its local high, from its June high, coming off 70%. And again, I think that this was a little bit the BitMEX feedback loop had a lot to play with that. Well, let's say that was off 64% and 50% off its local high. And if you look at where we are and say we came down 60%, this is the bull market breakout line. The line below it is about 60%. I hope I never have to bold this line, but I will if we need to, if it's in play, right? And that's not the only one. Yeah, all these lines just simply go back that you're looking at. You could, and they go back in this area too. I don't have them there now. If you like, but fine. 11 years is where I'm showing them, and that's the structure of the market. Continues to be in play on a zoomed out view and in a very zoomed in view as well. And is that possible? Could we see something like Bitcoin 30,000 in the midst of a crisis? This is looking at what a euphoric downside price action might look like. And look, would you, me, or anyone else be surprised if we came back into that horizontal pocket as well? No, it's in the book. It's possible. If that were happening, I think that would be the easy play. Again, if there's a panic, then likely it's leading to some type of resolution that ends up like that. The hard part to navigate, the grueling part, the punishing thing would be, again, if the business cycle were allowed to play out and we entered into some type of prolonged recession. Don't forget, China has been taking the stance that they're allowing the pain to take place. Their housing market is at an X number of years lows right now. For a long time, they've been watching these deflationary forces just kind of like wither away. They're feeling the pain, and they're in no rush to go ahead and cause any type of stimulus efforts that could go ahead and cause inflation. So if the U.S. and or global economy were to, I'm talking about Europe, U.S., if they followed a similar path, and I feel like everyone's fighting or be like, I feel like everyone is kind of like huddling up, trying to like fight for themselves at this point. Maybe the U.S. and Japan are working pretty tight in unison right now. We will see. We talked about a lot earlier in the year that likely this crisis is not caused by something within the US, but potentially either the EU or Japan. We've seen some warning shots being fired from Japan, but ultimately it could even be the EU that we see the bigger crisis emerge from. And in that situation where we enter into a prolonged slowdown, and it takes years to recover from, if the business cycle is allowed to play out, then that would be the pain trade for Bitcoin. That's my own personal opinion. For sure. I'm under the impression, and I think a lot might change this week. And again, I want to see how the market basically reacts to news, and that news would be if we did see job revisions that wipe out all the 2024 gains, and in depending on what Powell says. But as things stand today, I think that Russell reacts favorably into the first cuts, and if it does, that could be setting up a really zone to be looking for. But Luke, maybe too many people are looking for that. Maybe actually too many people are focused on what happened in that area, which is why people are looking for something like this to occur on the S&P 500. On the Russell, that would actually be taking out its previous high. So for the Russell, we'll be looking at how far off. Peter said we were 10% off in 2019. Currently, about the same amount off. But yeah, I don't know. I say yeah, but I don't know. We'll see. Um, yeah, thank you, D Power. That's really good. Always looking for where you're wrong. So does the potential exist that Powell comes out this week and is like, listen, once again, like we need to see further development as far as our target rate of 2% inflation. We feel like we're making progress, but we would like to see more. Maybe. I mean, he has qualified that each and every time that the only thing that could change that would be the job market. Tomorrow, the revisions are, unless I'm wrong, but tomorrow is when we're expected to see the revisions. And that, I mean, that data likely sets up a layup for the go ahead for the Fed to begin cutting. If that did not happen, if we did not see the Fed to begin cutting in September, each and every time, D Power, we saw market expectations for a cut, and then that was pushed back. The Nasdaq and S&P 500 have reacted favorably to it. So, I mean, I suppose that could be pretty good. Yeah, I think yesterday we talked a lot about. Um, I think yesterday we talked a lot about we have to watch for when the time comes for the cycle to be extended, where that intervention comes from. Does it come from the Fed or does it come from the US Treasury? And it appears that in the longer term, that the US Treasury is laying the groundwork where they could be implementing some type of yield control curve. They say that they don't plan on increasing buyback limits for the next several quarters. So that's almost into 2 years. That puts us into a time frame when we should start seeing like the whole narrative should be about commercial real estate as it's really under pressure. Could we see towards the end of this year any intervention from the Treasury? There's a good article also on Zero Hedge today, and it talks about into the end of the year, Treasury and new issuance. It's from Simon Black, I believe. I'm going to go ahead and see if I can post this one. I don't have it, so I can't post it. But we have right now about 300. I'm trying to find out where my reverse repo is. I'm not seeing it right here. We have about just over 300 billion in the reverse repo, and if the Treasury begins a bunch of new issuances into the end of the year, perhaps into the election year, into the election, it's speculated, or my speculation was over here as they began their massive effort that it would come from the reverse repo. It has. They still got a lot of juice in over here. If that's taking place, uh, that should be benefit risk. Um, so moving forward, Gary Gary Gensler for U.S. Treasury's secretary. I mean for U.S. Treasury, yeah, secretary. Yeah, I mean that seems silly. We'll see what happens. I don't really, pay mind to that. I don't think anyone's in a rush to get rid of Janet Yellen as U.S. Treasury Secretary. I think that she is doing a job that those on that embrace those type of I I think she's the woman they want in place right now. But I don't. Sorry for giving that so much time. I don't think that deserves any of our time or attention. Uh, Nasdaq, Bitcoin, and I wanted to talk about knowing like when to be in the market, when out, and following a mechanical system. Because Bitcoin yesterday, taking a long trade, stopping out, full stop loss on that, about 2.75, 2.8%. And I would think that yesterday, from a discretionary view, a lot of people felt like, well, I'm pretty bullish on Bitcoin. I want to be long here. Regardless, that's what our mechanical edge had done as well. And now we're in a situation where we're left naked again. When I talk about left naked, what I'm talking about is that when we entered short over here, we were then stopped out. And then for this whole move down, we don't re-enter on Bitcoin until we get a reset on the sell side. Obviously, not true on the buy side. We have multiple re-entries. But on the sell side, if the entry doesn't occur upon the crossover, you can see the crossover occurring right here. We're short, nice trade. But if it doesn't occur as just occurred on this new price bar, if it doesn't, excuse me, right here on the stop out, then you don't re-enter the market or look for shorts until that resets. So again, true to form, why people from a discretionary lens might be saying yesterday, I want to be long. I'm glad I'm long. Today, there might be a lot of people saying, and they might be right. I don't know. I mean, we are in a tight range going sideways, and it's true that yes, that the floor could fall out just over here as we could have had a breakout. But there are a lot of people probably likely and maybe rightfully so saying, well, I I wish I was short right now. And what the strategy is doing is saying, well, right now we're kind of chopping around. So we're back on the sidelines, ready and willing to attack on the upside if any type of upward momentum regains. And we need a reset on the short side. And there's nothing else to say except that you're left naked, or I'm left naked on the short side until a reset occurs. You cannot argue or begin to argue with the back or forward test of how that plays out, even though there are occurrences like this one here. And then in November of 2022, where a similar occurrence happens right over here. Those are two occurrences where you're left naked, but overall, that's two trades compared to 451. You can't argue with the forward test and or back test. It's just the way it is until we are able to make further progress and maybe develop a better model. BTC 108, 1 second. And then, thank you. And then, where's my Discord? Because there was something on. Hold on 1 second, Ace. Um, I lost my train of thought. So maybe it was, and I think it was. Even though left naked here on BTC 107, you still have the beautiful hedge going on here as Ethereum is holding an open trade well into profit. by the way, you're looking at another entering short after closing out the trade on 2.0. But over here on CTMX, ETH 103, holding the open short trade. And if we were to see a rollover, you're not like completely left naked. Bitcoin would be Ethereum would be capitalizing off of that. Cardano remains on the short side, and Solana here has been grinding throughout all of this period and all of this period. BTC 108, let's take a look at it, see what you're looking at. I'm going to go ahead and jump over and bring up what's your eyes on though, Ace? Ace, what are your eyes on? I think so. I think that at any point in time though, again, if you were to see for whatever would be the cause of it, but if you see Bitcoin here able to break out outside this consolidation, for sure, in my opinion, it's bringing ETH with it, and ETH will be screaming to the upside. Trading differently. Let me try to pull them up next to each other and just take a better look at it. By the way, before I do that, and obviously here, Bitcoin on the daily continues to be just waiting on the sidelines here for any further reception out of this range. And BTC, buy side only, BTC 101 here, very similar over here. There was talk inside the Discord this morning, and I thought I had it pulled up over here, and I'm not seeing it, so I can't discuss it. But it was talking about removing the JV filter, right? Which, I mean, it makes sense in so much as that we talk about when you're seeing very strong impulses take place on the buy side, how CTM 2.0 has an advantage over X. It's very mild, but it's there. And in the bear markets, obviously CTMX has an immense advantage. But I'm just going to take a look at it. I believe it said from 2014 early on. Let me remove it and take a look at it with you. So I'm going to let go of the JV filter over here. This is from 2014 to present. So that's pretty, it's taking away just the hype phase from before 2014. The drawdown 12.5%. I mean, you're talking about a difference of 24 trades. That could just be the difference of a few trades early on compounding. Let me look at that from 2020 to present. So taking off the filter. Yeah. So this is with the filter off, and you could see with the filter on. So I'll address it in the Discord, but what's happening here is that you're looking at a few different trades early on that with the filter off benefited, and that's actually probably reflected maybe let me look from 2016 on of the hype phase, because when you're in a hype phase you're better off without the filter. So if at any point in time we see a massive break of the dam and global funds flowing into Bitcoin, diminishing returns will obviously be disproven. But for us, that would mean focusing a lot more on CTM 2.0. But I'm going to remove the filter now from 2016 to present, see what the difference is. It's a little bit more. So I'm trying to see when that stopped. Was it in the end of the bull market of 2017? So from 2017 to today, the using the filter is providing a better fit. And again, if at any point in time we saw massive volatility increase because of any type of Bitcoin adoption, you like have that awareness. You're better off removing the filter here, and also maybe to like CTM 2.0, buy side only. But we're not there now. But we'll look at that again later if that when that situation arises. I believe it. There's a good chance it arises one day. Just taking a look here at a closer view of BTC 108 versus BT 107. By the way, BTC 108 we know outperforms BT 107. BTC 107 though is just more consistent in more periods. So let's do just this year. Now let's 20% on BTC 108, probably outperforming a little. Let's do since the top of the last bull market. So, and I'm curious which one's outperforming. In the long run, BTC 108 outperforms. You could see it also BTC one outperforming. The drawdown is pretty close. Huh. And just to give you a perspective of what I mean by outperforms, here's from 2016 to present. So here you have a 16% drawdown, 561% return, with a 12.5% drawdown, 254%. So I am aware and I know that BTC 108 offers higher profit potential. The drawdown is pretty close, right? So someone else's personal preference might be different. And BTC 108, by the way, able to clear profit on that last trade over here on the short side. So that was kind of nice. I think so. But again, I don't think this cycle gets started until monetary policy aligns. Right now, and it's not as it's probably it could be it probably is not as quick as like at some point in the near future we begin to see markets beginning to crash and we start seeing this view take place and the Fed comes in and returns to outright easing. It's probably the next thing that happens after the cuts is that some way or another, whether it's first coming from the Treasury and for something like their new issuances into the end of the year, or if it's something bigger from the Treasury, like yield control curve, which I don't think it will be, or if it's the Fed after that, like buying time is the name of the game. Buy as much time as possible. They don't want to reinflate until they have no choice. So likely we see some type of, right now we're seeing a reduction of the Fed's balance sheet. Likely, first we see some type of expansion of the balance sheet before a return to outright QE occurs. And they're going to try to buy as much time as possible for that to happen. Yeah, I don't. How do you sell on the sell side? So on the short side, when you're shorting, you're selling, and then you buy back to close the exit. Yeah. All right, everyone. So hyping over that you were bringing up the JV on BTC 107. So I hope you got to see that. And you know, I guess since 2017 till today, using the JV is providing good sauce in any type of hype phase price action, the JV will actually inhibit profit, and it's better to have it off. Oh, I didn't get a chance to, and we need to review what's taking place over here. Clara stocks, and what is the Nas doing as we speak right now? Nasdaq close to its lows of a session, off almost 0.5%. We're seeing a new position on FNGU entered, and now as it's minus 1%, getting ready to drop that and get rid of it, which is awesome. What's the average loss on FNGU? Right? So the average losing trade is 4.79%. If it's cutting this one short here, and who knows what it's like by the end of the day, it might even hold on to that position by the end of the day, depending on where we close. But love keeping the average win, by the way, too. The average winning trade is 38%. So you're looking at roughly a 7-to-1 risk to reward, a little bit better, almost 8-to-1 risk to reward on FNGU. So you're looking at here, trade in place, getting ready to exit. You're still looking at TQQQ holding its latest position, and NVIDIA also holding their latest position. Tesla was kicking off and looking for a buy entry earlier in the session. That since now has faded. We still have a lot of trading to do before this session is over. So it looks like the Sorrentine ratio on that is, let's see what that is. Seven to one is tremendous. I mean, a 7-to-1 Sorrentine ratio is absolutely bonkers, is the word for it. Amazing. People consider a 3 to be very good. This is a 7. This is kind of cool. This is, I assume it's not said. I think they're talking about the S&P 500 here when they talk about if the market falls. So I suppose it could be the Nasdaq, but obviously gains and losses on the Nasdaq are a little bit greater than the S&P 500. I'm assuming it's the S&P 500, and it says like, you know, if you have $1,000 cash on side, you could use this here for mechanical trading, which is why I want to bring it up. I think that this is really cool to talk about. So say you had $1,000 on the cash waiting to invest. And it says that if the market falls by 10%, you invest $100. And that happens roughly every year. And if it were to fall 15%, you were to invest 220, and that happens every 24 months. And so on every 4 years, 20% drawdown, adding a little bit more. And then you could see, since this doesn't happen too often, every few decades, the amount begins to diminish. You want to make sure that where it's more frequent, every 2 years and every 4 years, you're getting the more in. What happens if you were doing that with a mechanical system? I have over here stocks, but this is for sure as appropriate for Bitcoin and crypto. And let's say that you were doing this, and we'll look at FNGU since but we don't need to. Actually, let's do this on Bitcoin. We'll do it on BTC 107, and you could see, like, you know, the drawdown here is 12.5%. So you could see over here, what happens if every time there was a 4% drawdown? Let's say you had cash on the side. So let's say that this account size was, let's say it was $1 million, and you had another, let's say $200,000 on the side. And every time there was a 4% drawdown, you were to add X amount of your cash on the side. And every time there was a 7.5% drawdown, you added another X. And then every time there was a 10% drawdown, which has only happened once since 2016, you would once again add. And and I think it's really cool if you go into the discretionary channel and you look at the people using prop firms to trade futures, and you're able to use that, and you're able to like use that as an avenue of gaining capital in a nest egg, and then reinvesting them into the mechanical strategies and doing it in periods of drawdown. I think that adds a nice dynamic of money management that could really be uh see not only a smoothing out, but a much more effective way to use capital. So I like that idea a lot. This was reminiscent of someone was talking about real estate investing, and they had bought a unit in San Diego for $625,000 in 1991, and now they were exiting here. What is that? That's like 30 something years later with a gain of $1.5 million. And they're like, real estate is the only way to go. That same amount invested in the S&P 500 in 1991 would be $20 million today. Obviously, uh, making it a much better investment, which brings us back towards the best of the best have not been able to outperform the triple Q, whether it's Warren Buffett, Bill Ackman, Ray Dalio, Paul Tudor Jones, Gene Simmons, yada, yada, yada. And then we talk about, well, that's nice, but try doing that with the T triple Q, right? Which is the triple Q leveraged, and then doing that on a trading basis. And that right there is beautiful. All right, CTM, let's get back to it. I wish you all a beautiful day. Smash the like button on your way out. I hope you all have a beautiful day. We're going to continue navigating all of this together because we don't know what comes next, but we would like to make sure that regardless of what happens next, we're able not only to keep the awareness about us of making sure that we have the clearest idea, but make sure that we stay on the right side and profit from it. Have a beautiful day, everyone. God bless you. I'll see you all tomorrow.